AMC, and Taher, Badshah, the Senior VP and Fund Manager at Most AMC. Gentlemen, thank you very much for joining us. And just to add, this is because their asset management fund, the AUM, has reached over 6,500 crores. That is over $1 billion in June. And hence, what lessons have they learned is what we are going to ask them. Thank you very much for joining us.
Thanks for this opportunity.
Well, to start with you, Raamdeo, I'll come to your fund in just a bit. But what did this earnings season tell you? Is the economy recovering at a micro level? Did more companies tell you that they sold more? Did the Imamis, Daburs tell you they sold more sachets? Did the power equipment or the capital goods guys tell you that they sold more volume, not revenue?
I don't think that's the story. I think this quarter's, of course, we were expecting some surprise in the earnings side, but I'm really surprised by the extent of margin expansion because of the collapse of the commodity prices in oil and other lot of soft commodity, hard commodities which have fallen, and the pricing power has been fully used by the companies, starting with Maruti, your Britannia, your Pidilite and Asian Paints, you name it. All the companies which had pricing power, their margin EBITDA expansion has been almost 400 to 500 bips, which is staggering. On a 12-13% kind of business, you go to 18%. It's like a 50% expansion on it. Then you don't care whether top line is growing or not.
Absolutely.
You know, so that's the kind of and it is not the lowest oil price. Still, I mean, after the results,
they've fallen further.
They've fallen further. So I think for next 2-3 quarters, September, December, I think for the whole year, I think this segment is really going to do very well.
But Raamdeo, isn't this a risk as well? Because if the top line doesn't grow, then this is a bit of a one-trick pony, right? I mean, if for some reason...
We are talking about right now. Right now, the situation. See, this is all dynamic situation. Economy is recovering. Government has started spending. They're spending to the extent they can spend. So clearly, I'm hearing some green shoots from the automotive markets and all. But it has not become very strong. But I'm quite sure as the cumulative build-up of the government expenditure happens, this is 3 months, 6 months, 9 months, and then the revenue pick up. Because it's a circular kind of thing. You spend more, you get more revenue, you spend even more.
Okay.
So
no, actually, I wanted to take Anuj's question further. I mean, should not fund managers now stop worrying about top line and worry more about volume of sales? Because there is a secular fall in the realization, in the price. But that doesn't mean the company is not making money. They are able to cut prices probably because they are buying their inputs much cheaper. So as fund managers or even as stock pickers, is top line going to be ignored and you will look at volume and margins?
No, nothing will be ignored.
Okay.
I mean, fund manager is going to look at in a specific company everything. In the sense that company, if it is a cyclical company.
No. Are you going to be put off just because revenue is like 5%, but volumes and margins are making up?
No. It's individual stock. I mean, every company has a different story.
Yeah,
say a company called Britannia and all. So they have expanded the margins, they've got the volume, they've got the sales, everything going. I mean, good volume, good top line, and terrific margin expansion. Okay. So you can get all types of colors of the companies, but if it is associated with the volume growth, pricing growth, and margin expansion, that's the dream run. That's the dream run. So volume expansion, but there will be a lot of companies where there is no margin right now, but your volume is going to just explode. Okay. So all kinds of stories will come. So this is an opportune time, and it's all going to happen in next 6 months, 6 to 8 months.
Okay.
New stories are going to just start.
Indeed, in fact, Britannia is up 200% in last 1 year, as Raamdeo pointed out, almost everything going in its favor. Taher, good morning. So $1 billion in your funds. What's the next target? We say that $1 billion is a lot, but given the kind of equity culture that's now beginning to take place in India, anecdotal evidence of a lot of gold investments, real estate investments shifting into equities, what kind of domestic flows do you think can come into equity markets?
So yeah, it's a great time. I mean, this whole rotation in asset classes is clearly going to be beneficial to equities, and we are significantly underinvested in equities from a household perspective, as we all know, running into single digits in terms of exposure. So there is always a lot of headroom which is available, and the market has probably started to realize that opportunity in front of them now with the new configuration of the government as well as the whole economic configuration that we have right now. So I think the future is clearly exciting. I mean, if you look at the statistics on mutual funds itself, I mean, we've got a flow of $4-5 billion in the last 12 months, and we've got an equal amount in the last 10 years. So, that's a staggering number, and and we are still significantly below what we can probably be in terms of potential. So I think the headroom is enormous, and many of the mutual funds are getting into shape. They're getting up very well. Performances are improving. So I think we'll see a lot of action as far as domestic mutual funds. I hope we come to a stage where our dependence on FIIs and talk about daily flows based on FII numbers, etc., probably becomes much more muted going forward than we have been in the past.
Okay. Well, I'm dying to come to the stock-specific lessons that you all got from the first 1 billion. Let me start with you, Manish. The big powerhouse, or at least one of the big powerhouses in the last few weeks have been public sector banks. I've gone through all your lists. Barring State Bank, there's nothing. You don't buy this idea?
Look, there's a lot of problem in the public sector banks.
Yes, of course. But I thought buying in distress was what the market is doing.
But is it the end of distress? That is the moot question. The government has announced that 70,000 crores would be infused over a period of next 4-5 years. But is the problem not much more than what this 70,000 crore would do? Of course, it would alleviate a bit of the position, the stress position. But size of the NPAs is just too big. Within the PSU banks, a lot of NPAs, according to me, is still hiding within the restructuring thing, right? So
now it's called refinancing as well.
So do you play valuation, or do you play, the earnings growth? What sort of an earnings growth is going to play out over the next?
Okay, so not your cup at all.
I really don't think that we are at the end of the NPA cycle just yet.
There was a grin on Raamdeo's face when we spoke about PSU banks, and I remember the central bank story that Raamdeo told us. But Raamdeo, that apart, you made a lot of money in some of these so-called high-price stocks. Whether it's Eicher Motors, Page Industries, Bosch, Bajaj Finance. Some of these stocks are the stocks where retail investors would not want to venture because optically the price is too high. There's a bit of a scarcity premium in some of these stocks, but valuation-wise, these are very expensive stocks now. How do you justify some of these stocks as value picker now?
Taher has picked up all the
Taher,
stocks.
why would you want to sit on? Are you not tempted to book out?
Not really. We have done a little bit of rationalization wherever we felt that the growth is significantly less than what the valuations are actually calling out today for. But then there have been many others, despite the run and probably despite stretch valuations in the near term, have a lot of headroom for growth.
So what is the number that you look for? PEG, how would you decide Eicher is too expensive or Bosch is too expensive?
Yeah, I mean, if there's a stock, let's say at 50 PE, and probably it is still good enough for a growth of around 30-40%, at least visible growth over the next 7 to 8 quarters. Then that's something which is reasonably, we know that there could be a downside, we could probably see 5-10% come off, but we know that the underlying growth is supportive of higher valuations in general. But if there is a dichotomy to the extent that there is a stock which is trading at 90p and probably growth is more like 10%, then that's something which is going a little over the top. So there you would probably feel the need to rationalize and maybe try and see if you can correct that position, despite the longer term franchise attractiveness of the franchise of that business.
Just to add out here, without taking specific names, you take a weighted P of the portfolio per se, and then the earnings growth, the ROE, and there's nothing to say that we should only be looking at FY17 numbers. Markets are fixated about FY17. It is the valuations are expensive, but business of the company would continue even beyond FY17, right? And we are nobody to tell to the markets what they should be looking at.
So are you convinced by the business models that this kind of earnings growth that we have seen, as the base goes higher, that kind of earnings growth will continue?
That's what it is. Stock prices are nothing but evaluating what is the earnings growth and what is the longevity of the earnings growth. That is, if you get both these things right, it's a matter of time when markets get it wrong as far as the longevity of the earnings growth is concerned.
So you will not trade HDFC Bank for some of the new private sector banks?
Absolutely not.
Why not, sir? Why not?
He said no, longevity of the growth. See, one is the QGLP. I think this is...
Because I guess you're going to get a lot of private sector banks now.
Yeah, so we'll be open to it. I mean, at a price.
I guess the Ratnakars and all also will get listed.
We'll definitely look
and you also have IDFC. And
we will have, we are open to any company which makes
shows
money.
Longevity.
Yeah, longevity. Company is high quality business, high quality management. growth, longevity growth, not 8 quarters growth. I mean, like 8 years, 10 years, 15 years, 20 years.
By the time the company proves it, it's also become expensive. How would you guess the longevity before you get it?
So that's an art, no?
Yes.
That's an art, and that we are practicing.
Give us some lessons.
No, but lessons in the sense that, see, I'm telling you the factors we look at it. Every single company has to pass through QGLP process. Okay? Quality of business, quality of management. If both are not 10x each, it doesn't go through. We don't look at price. You all start with the price. See, the biggest problem in the market, in my opinion, is that people do valuation without understanding the values. Okay? So QGL is about the values. If you don't know the value, there is no point in looking at the price. If you don't know this is banana, how do you figure out what should be the price?
Okay.
You know?
Fair enough.
So I think we are spending 90% time, 95% time understanding the value. And once we know the value, then price is very easy.
Okay.
And you know, everybody's own money is also stuck with this. So it's not that we are speculating. We are investing. Seriously, we are investing.
Okay. Well, let me come to another sector, oil and gas, which has made a lot of money for you. You very correctly have invested in HPBP and not the upstream companies like ONGC RIL. Why would you do that, and why would you stick with it? Will you stick with it?
Yeah, so the idea was very simple that, the downstream companies is where the franchise value is significantly higher. If you look at these retail franchises like HPCL, BPCL, etc., they are the ones which are the most durable. As we discussed internally as well, that these are businesses, actually retail businesses that you would like to be in. There are no alternative kind of businesses, real brick and mortar retail, but no option. You can't actually do online buying of petrol and diesel. So, then there are only 3 or 4 players in the market, and these are guys who have are now seeing a significant transformation in the business value because earlier they were denied the due profitability that they should. But you
wouldn't ever go upstream. You don't see too many positives in those companies.
So, we still have the issue of the whole oil price, the under recovery burden, which is still going to sting them. And we need to see a situation where they get completely off it. If that happens, then of course there is a good amount of franchise value, especially at current levels, even for some of these upstream companies.
Manish, you have comments in your portfolio. It came out with numbers yesterday, and after a long time we saw the kind of rally. But overall, as a space, would you stay invested in names like Cummins, Voltas, and do you think the earnings recovery that we have started to see, is that sustainable?
Absolutely. One of the themes that we in the PMS that we are playing on is the Make in India theme. Right? Of course, India will move towards a self-sufficiency in the power situation. That could mean that Cummins as a primary backup power, the volumes would take a beating, and the lower HP would have lower margins. But the Make in India themes means that they can manufacture here and outsource to the rest of the Cummins subsidiary all over the world. The 60-liter engine is now being exported to China. That is seeing huge amount of traction. The mining segment, that is just about, what Coal India's production targets are for the next 5 years, doubling of production. It is consumable engines. So, as opposed to what the market believes, what is the growth trajectory, we significantly deviate from that opinion, and we've seen the numbers how they are playing out. In spite of a gross margin contraction, the volume growth has just taken care of the entire the growth trajectory. It's been very strong. And similarly, consumer discretionary now 21% market share in the room AC business. You've seen the margins, what we have seen, in spite of the industry going through a slowdown. I think FY17 for the industry as a whole should be a pent-up demand both from FY16 and moving into FY17. So at least, I'm convinced about the growth. Let's see what the numbers are. Till now they have delivered.
Okay.
We'll evaluate the situation, how it goes.
Okay, one philosophical question for you and then more stock specific for you all. What we are now seeing is a fairly broad-based mid-cap rally. You all have preferred to choose, in your fund, 50 stocks which you all monitor very closely. Will you change that philosophy?
No.
Or change the stocks?
No, it's a focus. See, this is a focus strategy. This is part of the QGLP process. You can know, as a fund manager, you can know very few stocks. Okay. It's impossible to know 70 stocks. So that will remain your philosophy? That is the core of the philosophy that we, in fact, if you see the names, we have chosen the names Focused 25, Focused 30, Focused 35. It's a focus series. So, though we have taken permission for 25, 30, 40 stocks, we don't invest in more than 17, 18 stocks. Okay. 20 is the absolute Lakshman Rekha.
Okay.
So, we don't have, and we are going to maintain that. and that may constrain, I mean, that may bring some kind of capacity constraint, how much money we can take till the performance gets hurt. But still, the promise is that we'll remain focused, we'll have fewer companies, and we'll have a chunky allocations to the, because if you have convictions on the stock, you have to buy 8-9%.
Okay.
I mean, with 0.5%,
then why are you getting out of Power Mech? You had 22%, you are now only 2%.
That's a different way. That's not part of the mutual fund. That's in private equity. And that fund is coming to an end. Actually, the tenure is on.
We have to wind up the fund.
We have to wind up the fund by December 2016. Okay. And we are going to line up 10 more IPOs in next 1 year. Okay. So clearly, this is, I mean, these are the best pieces of the businesses which we are selling right now. Okay. So clearly, I'm under compulsion to close sell it off, and good that markets are a little warm, so that we can, kind of offer to the public. But it is under compulsion that we have to sell.
Okay. Taher, really have to ask this one. Your biggest, stock has been Maruti. We've been talking about this. And you have been bullish at all levels on Maruti. Yeah. Is this still a yen story playing out, or do you see a volume growth story as well over the next few years? And would you stay invested in a stock like this, or would you add more at current levels?
No, we are up to our limits as far as Maruti goes in our fund. So, unfortunately, we can't buy beyond that 10% limit. We've almost gone to 9.9, whatever that number is. So, so I think, so we remain extremely positive. I think the company has done its bit in terms of ensuring a very healthy product pipeline. They have probably benefited out of the currency much more than many others in the business. But at the same time, they've I think now going forward, the story is going to be more about the top line and the growth and volumes. Plus, market will be keenly watching their success in the higher end, because till now it has always been perceived that Maruti is essentially about small cars and compact cars, and yes, it is. Even probably for the next 10 years it will remain so. But clearly they are adding on to the new piece. They are taking steps in the right direction. Separate brand, separate suite of products coming up, and it remains the most profitable enterprise.
But, so I was reading somewhere its market cap is now higher than Suzuki's itself.
I think Suzuki itself is all about Maruti India, so it's not surprising in a way that stock is hitting new highs.
It's not a Japan story, it's an India story.
What's happening to Maruti Suzuki India? So I guess it's always been so, but now the true color of the value of the business is emerging. So we were fortunate to actually get a lot of it in the distress of the last 2-3 years when a lot of problems were happening with the company. Okay. So this is about buying some very good quality companies in distress, and then you make some supernormal returns. Okay,
your most interesting stocks for the next 1 billion opportunity or 1 trillion opportunity. Manish, you have DCB. Would you prefer it over Kotak Mahindra? You have specialty restaurants. Would you prefer it over Jubilant Foodworks? Why these?
So see, a company has a breakup value, a franchise value, and a growth value, right? And out of these 3 values, if there is a less than fair value that is coming out in the stock price, there is an opportunity. So at 600 odd crores market cap, whether specialty does have the room to grow, does the franchise value represent a value much superior than what the market cap is? Because traditionally his ROEs and ROCs have been quite good. So it's a play in the consumption space, dining out, this has gone through a slowdown. That creates an opportunity. If we talk about a DCB, is it the next HDFC Bank in the making? Everything begins with a small, 10,000 crore book, 3,000 crore market cap. I think the credit appraisal is their chief competitive advantage. Okay, and it's the Aga Khan.
That's the soul of a bank.
Absolutely, it's the Aga Khan Foundation, which is the promoter, and which also promoted HDFC Bank. So that learning is there, right? So, and you are able to grow your balance sheet 25% with minimal NPS. That is all that we need for a bank to do right. And if that comes, markets are okay about it.
Okay, Raamdeo, really have to ask you this one. How do you play a story like Nestle? Because there's this whole scarcity premium, of course, in terms of equity, but 25% of your business is going through the kind of mess that it's going through. Good opportunity right now for Nestle, or would you rather let it pass and look at it later?
I'm really surprised by the price movement of Nestle, despite once in a 30-year kind of a loss, and yet the brand is not back on the shelves. I mean, now I think there is a much higher move. I can see much more sympathetic statements in the headlines today. But yet the permissions are not come, brands are not back, and it hurts a lot, this kind of brands out of the shelf for a long period. And despite that, it's almost all-time high. 60,
yes, the price has not come.
Practically there.
Yeah, so market has voted with full confidence. See, with the current valuation, it will be a very average return. I mean, even if the company does very well. But longevity, if you want 15-17% return for next 20 years, 25 years, you can buy even at current price.
So a pension fund should buy.
Yeah, it's actually fit for a pension fund, and probably it will be an index return. If index has done 17% for last 34 years, clearly it would match or probably be out 2%, 3% higher. You know, because you are buying at 65, 70p, even if you talk about the normal P. So I think it's a very long term, very good investment, but it is not a multi-bagger by any stretch of imagination.
Okay, that's very useful advice. Actually, we have many more such questions for you, but the bell is ringing in